Welcome to Lighthouse Outlook, the podcast where we talk less about the markets and more about what matters to the people navigating them. From family offices to founders, we go beyond the numbers to unpack risk, legacy, and the human side of capital. Hosted by the team at McNichol & Associates Asset Management.
Okay, well, take it away, Joe.
Okay, thanks very much, guys. Good morning, November 13th. And here we go. Just an update from Talmax, mainly on the residential side, which is the majority of their business. And then we'll get into charts of the week. Brief reminder, Talmax is our fiber optic internet and TV phone company. And if you're interested, they're doing their Black Friday promo right now. So some good sales volumes with this company. There's some actual charts that they started producing, which we'll get into. I'm not going to read off all of this kind of information. This is from the update from the CFO, but certainly some good increases in gross sales there. Just under 200 new sales this week, with direct sales up by 54%. And inside sales up about 127%. I think that's the promo going around. And web sales were down slightly, but that's only 7 versus 16. And I think that's just people clicking on their website and signing up as they fire Rogers or Bell. And then the Good Friday promotion, which you saw on the website, inbound sales calls higher. So, everything's with this one seems to be coming along nicely. So let's take a look at the cumulative gross sales. The granularity of the charts is just because they were fairly small, but you can see here that they are proceeding in a positive direction. That target is for the overall product lineup, and you can see direct sales comprising the majority of the company's residential build out. The customer count is increasing pretty steadily, I would say, though you'll notice that this summer, it has picked up a bit. And I think that, in speaking with the CEO, it seems to be the case that, not only are more of their kind of internal business development initiatives picking up, but people that are with the incumbents, again, the Rogers and those other providers are starting to get a little bit fatigued with the lack of service over there. So they're moving in. Residential installs are as is indicated on this chart. It does move quite a lot. And one of the things that we talked about, their newest market in Barrie is off to a very good start. And sort of that's by design, because in the winter, as the ground freezes, it becomes a lot harder to bore into new homes. So that's that. Now, the penetration by municipality, I think this is, for myself, the most interesting chart. So they started off kind of in the East End, north of myself, in Brooklyn and Stouffville. And so the penetration rates there are higher, but then these are much smaller markets. I think, in fact, the best sort of lines here are going to be Newmarket and Aurora, because those are much bigger cities than Brooklyn is just, it's really nice, but it's literally like a one street town with some nicer parts on the side of it. It's not an enormous community. Like the community that I live in here in Scarborough probably has twice as many people as all of Brooklyn does. But with Newmarket and Aurora, you're getting into definitely some larger size cities there. And so the fact that the penetration rate is increasing and moving higher, I think is positive. Richmond Hill and Markham are even bigger than that, but these are newer markets for them. So that penetration rate is only just starting. And I think from all of the cities listed here, population wise, it's got to be a pretty close drag race between Richmond Hill and Markham. There are a lot of residents living in those two towns, and then Newmarket and Aurora as well. So that's a look at penetration. The churn rate has been, I would say, I guess, steady to the extent that it's been, there's a lot of numbers on this slide, but the churn rate's kind of been in between that 50 and 100 basis point range, which is, I think, well within the target rate. And then as you get into, the latter part of the year and holiday season, I don't think too many people are going to be, necessarily, for better or worse, finding their internet and phone and TV type of provider. All good things over there. in terms of charts of the week. Andrew really doesn't think that the markets, technically have put out sufficient evidence to suggest that top to the rally has been made. He does sort of take a few cheap shots at the whole idea of the U.S. government shutdown. I think the S&P actually went higher when the government shut down. For what it's worth. And he's kind of saying, irrespective of the reason, behind the bounce, that there's now some margin for, pullback without the index getting beaten up too bad technically. So, for the first time in the last couple of reports, he's starting to sound more bullish again, and I think he's back to dropping the 7,000 number for the S&P 500. And so here it is here. It did actually go down through the actual moving average, right? The 50-day moving average, which it has not done so for a really, really long time. You can actually see here it came close a little while ago, but beyond that, you really got to get into the trade and tariff tantrum to see stocks really kind of punching down through that 50-day moving average. So very interesting. The risk on, risk off indicator literally pulled a U-turn and started going straight up. So it's back into that quote strong range that Andrew has. And again, this is his own sort of proprietary indicator of technical data. Looking at the markets, what do we got here? I think, the US dollar is certainly starting to go higher. That's I think material. You're starting to see that sort of impact stuff across the board. What else we got? Gold, it peaked out there. He's got a gold chart coming up, so stay tuned. It did have a little bit of a sell off there for a bit. And it's going higher. It's going higher while the US dollar is going higher. So that's interesting as well. Some of the indicators across the markets are looking, they're mixed. I mean, these are, I can't really make much out of these. They're very kind of all over the place. So we'll skip through those. Here you've got a variety of sort of support zones and overhead resistance. But again, Andrew feels sort of more on the side of the bulls in this case with regards to the S&P. And so, as you'd expect with this rally since April, I think the bottom was, April 8th or something like that. There's not too many bargains out there. I think the whole planet is talking about AI, and I know NVIDIA reports soon. We saw Palantir report, and the report was fine. The guidance was a little bit, I think, weaker, and the stock got beaten up. But the point of this slide is he's saying, well, there's not a ton of deals out there, but one of the areas where you can think about going is these consumer staples. Now, there's some qualifying terms, but the main reason for that sort of broad statement is this sort of double bottom here in this select S&P consumer staples ETF. It looks like RSP, but it's actually RSPS. So kind of interesting there that it's double bottomed. But he does point out that, guys like Walmart and Costco are actually really expensive. Procter and Gamble too. And I haven't checked into some of the other ones that make stuff like Clorox and some of the stuff that you use in the, at the house. But Walmart, I mean, the PE ratio is at 40. I did not know that. And so, that's something to be aware of. Anybody that's even driven by a Costco parking lot probably knows the story there. It's pretty much full all day, every day. And on evenings and weekends, don't even bother going there. And then crude oil. So crude oil here is putting in a what he calls textbook flag pattern. And so, it looks to be kind of breaking up from that flag. That would sort of have a positive impact, I think, on Canadian equities with regards to some of the oil and gas companies. I know we're involved in some of those. So there it is there. And with gold, he for a couple of weeks was really using terms like uncharted territory, uncharted technical analysis, haha. But he kind of stopped making overall predictions. And this is the first time in several weeks that he's kind of pointing to a spot that is essentially an entry point for gold, which is a couple $100 per ounce lower than we're at right now. And so he's essentially directing us to the 200-day moving average, I believe is the blue line. and that average sort of gets you to this green zone of support. So if gold sells off, potentially an opportunity. And then just finishing off here with the Chinese internet stocks, KWeb. I think with this a couple of weeks ago, he did kind of indicate that the bounce, which is really really hard to see, but it's this first very tiny black arrow right here. That bounce up was pretty robust and healthy, and he viewed it as an opportunity to maybe pick an entry point to Chinese internet stocks that turned on him. And obviously if it crosses through this lower area over here, would be a fail. And so he would probably encourage you to run for the hills if that happens. For what it's worth, that's Chinese internet stocks. And that's it for me, Dave. Thanks.
Thanks for that. Ken, you ready?
Yep. November 12th, the report. Same disclaimer as Joseph, so I won't get into that. I'll just be pretty quick this week with the indices. Over the week, there was only a $1 decrease, 2 column reversals, so it dropped off last week to end the week and then has reversed since. Has some really strong support it's created over the past 2 weeks, so something to note there. The melt up seems to be kind of on pause. I mean, we are at all-time highs, but for one time, I'll show a slide later on. It seems like there's a bit of a divergence in these Mag 7 names / I think there's a different nickname for them related to AI or something fantastic, something I forget. But nonetheless, you can see here, CoreWeave worrying some investors. We'll have to see what happens there. Obviously, some big drop off there, even though they beat earning estimates, I think, but a project did not get complete with one of their customers, which has caused them to decrease their revenue and income outlook for the full 25 year. And they've also added on a significant amount of leverage since their strong IPO back in May. So something to watch there. Overbought, oversold actually did increase this week to 47%. So some positive technical data there. NASDAQ, $2 increase. Same thing. Strong support lines here. 4 and 6 boxes lower. Overbought, oversold down to 41%. It seems like for now, the extreme overbought levels are over. Investors are slightly slowing down their buying. Obviously, a couple risk factors on the minds of many, including the government shutdown, which continues, overall uncertainty, and then NVIDIA earnings, which I think come on November 19th, which is next Wednesday, by memory. So we'll have to see what happens there. And then looking at the Dow here, large increase, really good week for value relative to growth. So something to watch there. It did create a new buy signal. That's the second straight. Overbought, oversold 77%. So there you can see the strong week, right, reflected in one data point relative to the more growth indices. That's the highest overbought, oversold since July 3rd. So a really strong trend there. And then in terms of a valuation multiple, Dow remains overvalued, but when you're comparing it to the past 10 years, it's only a slight premium, and a lot of that might be coming from some of the tech constituents within it. There are some strong value names across equity markets that are trading at, I'll call them, discount relative to their historical averages. So some opportunities out there. TSX 60 here, $5 reversal and increase. It did create a sell signal to end last week, but it created a buy signal yesterday. Yesterday's strength was on the commodity price movement. A really strong day for some precious metals, some base metals, and even some nice Canadian energy producers in the gas space. Really been producing some strong numbers. A company like Loblaws, I wrote about that in their weekly commentary, reported some strong earnings close to a 52-week high. So a lot of these TSX 60 constituents continuing to churn out strong numbers. We reported on this earlier this year that we were expecting some strong numbers north of the border. Obviously, the precious metal trade, we didn't forecast how good those numbers would be, but we're really happy with how we've been exposed in the Canadian market this year. I'm looking here at the VIX. Overall, the last few months, the VIX is kind of moving higher off of this bottom through the summer. It doesn't follow a perfect trend line, but you can see for the really only the second time in the last 6 months, it looks like it's breaking above this into a positive trend, which obviously implies a higher VIX. So something to watch there. Bullish percentage charts both move down, really follows the narrative of the lack of breadth in markets, both of them sitting below 50%. Really, the market continues to be pulled along by some of the biggest names. That's not just for the tech indices. That's basically in every sector. Some of the largest names are really outperforming. We'll call them the mid caps and small caps. I mean, when you look at some of the largest U.S. banks, really outperforming some of the regionals, and then even like a company like Home Depot, I saw over the last week some really strong performance, I think, by memory. Have to look at that. Quickly flipping here, not a whole lot of changes on these percent positive trends. They're a lot more delayed moving. TSX 60 bullish percentage chart slipped about 2%. So something to watch there, but not a crazy change in the last few weeks. Just flipping here, this is the asset class rankings. There hasn't been a lot of changes here. The only area that gained international equities really been driven by Latin America, which has really picked up some relative strength in the past 3 weeks. Obviously, we have some exposure, and we've been talking about Mexico for quite some time, and we're really happy with from when we entered the trade to now, the performance of that region. But we think the overall Latin American region is going to outperform in the coming years. The multiples in that area are really cheap. It seems like there's more stability coming to the region in terms of pro-bit business leaders. And it seems like you really can trust your capital there, or begin to trust part of your capital in those regions. So something really to watch. And a number of those countries, obviously, kind of commodity superpowers. So especially in some of the metals and the mining, really important to watch that region right now. We'll be pretty quick here. This is just the rolling 1-year average since 1995 of the PE ratio of all Canadian equities from highcharts.com. You can see how PE ratio, like I said, seeing just below 20 now, or right at 20. Only time that has been above that level back in the pre.com bubble era. Something to watch there. You can see the rolling average as well, and where that reached, and that looks like it's actually turning over for the first time since I think that's late 2022. Something important to watch there if this really does turn over and we get a pullback, especially north of the border. Now, I mentioned earlier, this is the tech divergence. This is the 1-month return of select large tech names. Now, I didn't grab every tech name, obviously, but there's a bit of a divergence here. We're seeing a lot of the hyperscalers still performing really strongly, specifically the companies that have really strong cash flows that can basically service these large commitments to CapEx, the Alphabets, the Apples, the Amazon, I forgot to put on there. And then on the right, Oracle and Meta specifically. Microsoft doesn't really make my point whatsoever, but Oracle and Meta really are going to have to finance this scaling through debt issuance. I mean, Meta has already done that with the largest private credit off balance sheet deal ever with Blue Owl at like 27 billion. You can see at the bottom here, these are two charts that basically track X as a percentage of total sales for Oracle. Back in the dot-com bubble, that was sitting around 5, 6, 7%. Now we're at about 57%. So what happens if there is a bit of a slowdown from some of these companies like NVIDIA or OpenAI, and this circularity of the industry, like I've always talked about? There could be some large pullbacks with some of these names, and it's also going to get harder and harder once they pile on debt down the line. I'm not talking about in a year or 2 years, might be a couple years down. Just the interest to service the debt will really surge, and that's kind of a problem, and something that investors noticed with CoreWeave as well. Here, just looking at these two charts, this is just Dorsey Wright, more for the people. back end of the recording. These are just some names for some tax loss harvesting ideas. If obviously you've realized some large gains, it could be time to sell down some of these names and kind of minimize your tax bill. Unfortunately, well, fortunately, we actually don't really own any of these names on this list. I went through the names yesterday. And these are basically companies within the, I think, S&P that are down basically 20% or more so far this year. I think we entered a few of them at one point, but really scaled back on them at the start of the year. So really not tax loss candidates for us. This is just a chart of small caps, the ETF IWM really improving in the last few months, but you can see the pullback here and there's no real support. It's back below the end of year 2024 highs, some really cheap multiples within the small cap space. It might not be time to invest in the overall space, but buying some high quality names within that area could be a really strong time right now, especially with the pullback and the overall theme. This is just a chart that tracks the consecutive days with the U.S. equity core percentile ranking above 90%. So that means U.S. equity as a core asset class ranks above 90% of the other asset classes within Dorsey Wright. This has only happened 5 or 6 times, previous to this. And you can see the forward return of the S&P 500 when it falls below 90% after a 3-month streak. Currently, we are at a 3-month streak. We have not fallen below 90%, but we are getting there. You can see the forward returns 6 months down the line, 1 month, 2 years, some really strong returns, but in the short term, a few times at least, especially the COVID time, some large pullbacks, obviously, right off the hop. And then you can see here, this is the S&P 500 forward returns by U.S. equity core percentile level. Basically, how many days since 2003 to 2025 forward returns, how many days these have happened, and the ranges. And then down here, these are just cash proxy triggers, basically ranking where money market funds rank within all asset classes. So this is when money market funds rank above 50% of asset classes that Dorsey Wright tracks, 70%, and then this is in a range of 40 to 50%, and then 40 to 80%. And you can see the amount of days that has happened and the overall S&P 500 returns during those periods. So when these are really triggered in a 3-month and 6-month basis, obviously it is in an investor's interest to rotate into these money market funds rather than staying fully invested in equities. This is just a chart that I found interesting from, I think, Glenarchy Capital, actually, out of New Zealand. It just tracks the 10 largest companies right now in the S&P 500, up to 40%, which is pretty astronomical when you think about it. They make up about 30% of the indice's earnings, so there's a bit of a spread there, meaning we could get a bit of a pullback if some of these larger mega cap companies like Nvidia, maybe they don't miss earnings, but maybe the forecast is a little weaker. Maybe their earnings growth over the next year will be a little weaker. Maybe they don't beat street estimates by a wide enough margin. We'll just have to watch there. This is just US data centers, kind of a way of obviously playing AI and just looking at the investment. But we think that the best way to play this data center trend is through some utility providers and energy producers. You can see the growth really in the last 2 to 3 years of active data centers, especially their capacity. And then the announced future development has really surged since mid-4, almost to a point where the chart looks like it could pull back and correct itself a little. I know it's not a price chart or a total return chart. It's just a pure announcements chart. But usually when you see parabolic moves like that, and there's a lot of money tied to them, sometimes you get a bit of a pullback. This is just tracking the number of leveraged equity ETFs at a record high. I'm sitting right now at about 700, which compared to the day trading days of COVID, when the number was about 230, they have really the result of retail kind of buying in a lot more and continuing to markets really being involved at a rate that retail traders haven't been involved at. This is a bit of a sign, we think. Also, these trends don't occur at market lows. They don't occur in the middle of a cycle. Sometimes they tend to happen at the top. So something just for us to watch. And then obviously, a lot of people have been talking about this over the last month. Norwegian Cruise Lines. We own a competitor of it, which has performed a little better this year. But the large pullback sometimes in past cycles when the cruise lines miss on earnings and have some weak forecasts, it's sometimes a leading indicator for the economy and the overall health of the consumer. So something we're watching there. And I think that's it for me. So I'll pass it over to Dave.
Okay, thanks, Ken. Back to Michael Coolbaugh. His charts of the day, consumer sentiment. So he's showing a perfect illustration of the K-shaped economy. Consumers just aren't feeling the excitement about AI and the riches it brings to tech behemoths. AI capex is certainly masking a weaker outlook for the real economy. Credit spreads, despite all the claims that private credit is contained, BlackRock has become the latest casualty with a 100% loss. On a 150 million private loan, previously marked at 100 cents on the dollar. The K-shaped deterioration is beginning to reveal itself via cracks in private credit, and despite the equity calm, credit spreads are showing some angst. Yes. Hedge fund defensiveness. Despite some institutional dip buying last week, hedge funds continue to short this rally. Power surged in earnings this season. Further to my point from last week regarding natural gas, it seems to me like we've transitioned from a computing shortage to now an energy shortage. We have all the necessary computing via semis, etc., but how will they power those data centers? Nat gas is likely the quickest and most efficient. And Whitecap is a Canadian nat gas name. It's been consolidating since 22. We touched on the nat gas story last week, but if you're worried about where we're heading with inflation, commodity exposure is a solid bet. Yes, we've got that on our watch list. CNQ, another Canadian nat gas name that's attempting to break out from a downslope. An Eagle, or Anglo-American, excuse me. And on the top of commodity exposure, we're seeing more evidence of fresh breakouts from names across the industrial metals industry. Rio Tinto, starting to notice a theme, and that's it for him. So good stuff on Mike. And go back and finish up with the morning coffee, and then I'll do the playbook. So it looks like Manulife is in the news here. I have to read this. This just came in, of course. So looks like their Asia business continues to be supportive. Fed trying to talk rates down. It's surprising how much higher rates are in the US than Canada, but I guess that's more of a evidence of how weak our economy is relative to theirs. Not much great deal of change. You can see on the dailies here and the weeklies, you're just getting some slight green upticks across the board. NASDAQ down a little bit, and Australia, as that analyst from NASDAQ Dorsey Wright showed, that certain things are leading, like Japan and China right now compared to the S&P 500. But solid returns are really across the board everywhere. Now you go into the commodities, you get a mixed bag there with crude's, really struggling. But nat gas, that's something we'll definitely look for some breakout names there. And because we cut back on our energy quite a while ago, but maybe it's time to add. As I've been saying, we've been just holding our precious metals and getting continually rewarded for that, especially with the commodities doing really well of late. Copper's doing fine. I'll show the Canada US dollar on the point and figures, and same thing for interest rates. So finishing up with the playbook here. So really nothing's changed. Canada US dollar, same. Well, this has changed in the last 2-3 weeks, but both the short-term indicator is slightly down and the long-term indicator is quite a bit down. So this is probably going to continue to trade in a narrow trading range, really led by the US dollar spot index, which has traded down a little bit of late, but it has just a slight upside target. So it's sort of caught in a trading range as well. Talked about crudes and that, but you can even see it here on the forward vertical price objective for nat gas. So quite a bit higher compared to the current price. So that looks like it's in for a stronger breakout. A similar, not quite as much for copper. The uranium measures down. These are new for gold. So we're at 4,200 for the gold futures. Those measure up to almost 4,800. And spot gold 41.23 measures up to 44.60. So yeah, as I've been saying, inflation has not been wrung out of the system. Actually, another little factoid with the government shutdown. That means all those people who measure inflation haven't been working and, or at least haven't been getting paid. So they haven't been reporting on inflation data. So I think this is foreshadowing that they might come up with some surprise numbers when they are back to work, and gold has been forward looking there. Silver up big time, as are the miners, as are the juniors. Platinum is one of the most undervalued of the precious metals. We also own that, and that measures up quite a bit. And then the cryptos, they're continually a mixed bag here, so I'll ignore them this week. And then finally, interest rates. So really no change. 2 years the same, 5-year same, 10-year. Yep, 10 years flat. That's been consistent for a couple of weeks, probably 3 weeks now, and the 30 years down. So as I say every week, the steepening of the yield curve is there to help. So that's it for me. Sean, you want to take it over?
Yeah. My crypto exposure, which is what I focus on, has been high. I was slow to change. I believed more in narrative than the price action. At the end of the day, price is truth. So I'm making some changes. I'm de-risking. Already de-levered quite a bit, de-risking. But when we look at asset classes, the US dollar is a little bit stronger. That's weighed on a lot of things, especially on crypto, right? And also across sentiment tracking, like social engagement, there's just very little interest in crypto and in altcoins. And that's basically what's needed now to sustain the rally. People say institutions are coming. No, institutions are here. The only positive news I've seen is that the Czech central bank is buying a little bit of Bitcoin as a test, right? And if that becomes a mind shift in the central banking world, we could basically get to the potential year-end target of 140K. But it was a pretty boring week across the board. Notably, the S&P 500 over the last month is still up. Still have an administration that's biased dovish. The Fed is in an easing mode, likely heading towards yield curve control. The thing to watch, ADP, last week it was up 42,000. And remember, it's a 4-week moving average. Right now it's showing down 11,000. Last week there were a lot of layoffs announced. Inflation's above target. Nobody cares, right? One thing is, if you watch some of the sub indices, it seems like rent is losing the upward pressure. And that could be due to job losses. I don't know, but keep an eye. That's the thing to keep an eye on. Atlanta Fed GDP now sitting right on 4%. So recession, certainly not by the numbers. I did an analysis this morning of a whole table of macroeconomic indicators. I just want to know, are there countries out there that are doing okay, that are actually growing their GDP based on productivity and their real GDP, right? GDP less inflation, based on productivity from companies doing well, industries doing well, population growing. And the what came back were, on the surface, South Korea, Japan, the US and Ireland are countries that are doing better than the rest of, I guess, the global 50. US dollar, the dollar index appears to be headed higher on a technical basis above this consolidation range. And a strong uptrend is going to result in a risk off period. It's as simple as that, right? If the US dollar rises, the price of gold will go down. But this administration supports a weak dollar to bolster exports for its reindustrialization of America program. Here we can see the US dollar by, the chart that I've created in TradingView, and you can see that it's broken above its moving average. In the heat map is all clear. That's saying the expectation is for price momentum to continue in the short term, which are the blue lines, the medium term, which are the yellow lines, and the longer term, which are the green lines. So this is looking like a stronger US dollar environment, and that just merits taking down leverage. right? That's where things get set up. Gold, again, I've said nothing stops this train. I got a few questions about like being stupid last week about saying this, but as you see, like we're back in motion higher, right? Like the US, based on its issuance expectations, is going to be massively flooding the market with debt, and they have to debase the currency to handle interest rate costs. So you can see like a week ago, we're basically at the bottom of that little dip, and we've had a few really good days. I think we're getting back on track. The heat map, which is the blue, the yellow, the green, certainly indicates we're getting back on track. And I thought about it, like the trade for the year, besides, I guess, AI, has been gold, right? Like just the amount of money that can address gold as an investable asset is the highest in the world, right? We're going into year end. Most managers do not have a lot of exposure to gold, the barbaric relic. And then I just thought, like, Tina, there is no alternative, meets FOMO, fear of missing out. Anyway, I think that we could see another parabolic move up in gold as people reposition to say, oh, look, like I'm in gold at year end when the reports come out. Oil, the sell off, there's just nothing good going on in oil, right? We got a forward curve that's US government wants gasoline prices below $4. They have them there. They're going to be drilling more in the Gulf. They're going to be drilling in Alaska. And I just hope they get this war started with Venezuela and take it over and send Chevron and everyone else in to like claim those oil fields to the benefit of the US investor. So here we see oil, that is not a good looking heat map, right? That is like, okay, you're below threshold on momentum across the short, medium, and long term. Just generally avoid oil, right? If you're going to be in oil, find companies that have really great cash flow or that are big enough to buy up these juniors that are going to fail. Rates and credit, not much happened over the last week, right? Pretty quiet. But I'll say this, like Gundlach pounded the table with an interview with Rosenberg, which I thought was quite good. And his thing is the US Federal Reserve Committee basically just follows the 2-year rate. So let's take a look at that. The 2-year rate here in blue heading down. Fed funds upper bound of the target rate in the dashed red, following it like a dog on a leash, right? Rates are going down. US equity, here's the easiest trade in the world. Just buy SPY, VTO, whatever you want. The trend indicators are fine. The earnings trend is fine. The VIX term structure is fine. Breadth is middling, as Ken pointed out. Sentiment right now is still fear. Like there's room for it to go up. Like people, like Tom Lee talks about this being the most hated V-shaped rally ever. And I think it's kind of true. I see this all the time. Everyone wants a recession. Everyone expects there to be a big valuation pullback. The Mag 7 concentration, as Ken alluded to, is a bit of a concern. But until there's a strong upshift in unemployment, I think the SPX is just like the easiest place to be. Like, look at this earnings trend in red, right? It's just up, up, up. It's above the moving averages. When it's been above the moving averages, the price level has followed. When we look at the technicals, I look at my heat map right away. Like it has been the place to be literally since April, right? It's been above the moving average. So the RSI looks fine. It's not overbought. I don't know what more people can want. If we see the price come down through the moving, that longer term moving averages, then I'll take down risk even more. To Ken's point about like PE ratios versus growth, like the one company I still like, even in the AI space, is Google, right? Google has the breadth of market to bring AI to so many segments to be productive. Like Microsoft would be right behind that. But like, if you want a pair trade, short NVIDIA, buy Google. Crypto price action is just down, down, down. US dollar is stronger, but the narrative is gone. Until the US government fully passes all the Clarity Act, the Genius Act, things get going, the banks integrate with Coinbase, this is dead money. I wouldn't recommend anybody buy Bitcoin right now. We're at the end of the halving cycle. This is typically when we are topping in past cycles. Maybe it extends a little bit. I'm just not seeing anything to support that thesis. Right? It looks like we're at the beginning of a crypto winter. Some of the names in the Bitcoin mining space have just had the snot kicked out of them. Like look at Galaxy Digital down 22% in basically, I think this is in the past month. Anyway, like just a nasty sector at the moment. This is a fickle market, right? There's no cash flow that comes out of Bitcoin. There's some cash flow you can get out of Ether, but when the sentiment is down by more than 10% in a short period of time, the narrative has changed, and I don't see, a quick flip. So this is my performance failure, like not enough trimming of profits after a strong year. US dollar is hurting, and I haven't really acknowledged that, but that affects my sector very directly. Social engagement is not there among the young people that are digitally native, and if they're not involved, that does not bode well for the space, right? Like most cryptos beyond Bitcoin are basically like a meme type play. And if those people are not there, there's just going to be no price support. We get days like that massive delevering day where the market makers just pull their liquidity and we're down 10, 20% on altcoins. So this is the end of the halving run. The US legislative changes are apparently like not fully finalized. It's hard to get good information on that. And even the expectation hasn't had the expected effect. So like I'm reducing exposure. I'm focusing on the price trend, not the narrative.
Okay, thanks. Well, at least you're figuring out your mistakes and they can always be corrected. The year still has some time. Okay, Gilbert, you wanted me to show that one slide?
Yeah, just a quick note this morning, given the fact that next Wednesday, we've got the NVIDIA earnings. I've been tracking NVIDIA for some time, doing historical research on it. And if you put up that slide, what we're looking at here is quarterly revenue for the company. Obviously, I think revenue is probably and I know the company earns a lot, but revenue is probably the biggest metric since it is about, growth. And so we want to see that the company is growing. What you see on the bottom, that bottom chart there, that third bottom chart, that's the one that matters. That's a year-over-year revenue growth, quarterly revenue growth. And what you can see is that those two periods where you saw red, negative revenue growth, that was aligned with NVIDIA declining 55 and 65% respectively. Now, the reason why that's significant is because we're already seeing declining year-over-year revenue growth here. So NVIDIA's really got to kind of blow it out of the park in the next quarter. If they even slow down a little bit, it could be the start of a decline into the negative territory. The issue is that I actually did a deep dive into the earnings and the price action, and unfortunately, NVIDIA started to roll over in both of those instances well before we got the negative year-over-year quarterly revenue growth, right? So again, markets are forward-looking, and you can expect them to almost anticipate what's going to happen. And as a result, you have a situation here where if this number does continue to decline, markets might do what they did the last two cycles with everybody screaming from the hills that we're in an AI bubble, whether it's Burry or anybody else. Everyone's going to have an opinion next week. And so I just want to take a look at the numbers themselves in history and put that into context this morning just quickly. So that's it for me.
Yeah, Burry's all over Bloomberg this morning, just watching the headlines while we're all talking. He's closed his fund down to new investors. He said he's going to have some big announcement on November 25. So I'm sure he's counting on the, November 19 earnings announcement for NVIDIA. That's his largest short. And so who knows? Probably a lot of other people will be lining up on that short too. Maybe they'll find a way to extend and pretend like so many other companies do. So, but thanks for that. Does anybody have anything else they want to take a look at before we say goodbye? Oh, Paul Beatty, there you are. You're on Montreal time. You guys get out of bed at 9:30, so take it away.
Barely got out of bed this morning. Hey guys, sorry, I've been very busy these days, chasing these crazy markets. Right, the one theme I think is so evident is the central bank buying, right, of gold. We checked back, almost $500 in 5 weeks, very quickly, for sure. Very rough, very volatile, but huge rebound. I think the conclusion is we are going to go test 5,000, clear as day now, right? We know who the buyers are, and the central banks are not going to stop. None of these guys are day traders, right? So the Brazilian government, you saw that announcement last month, right? The Brazilian government buying $15 billion worth of, or 15 tons of gold just this fall. I mean, what else do you need to know? Why would why is the Brazilian government buying gold? They've got a strong view that it's better than owning treasuries. I don't think you need to know anything more than that. Just to add up, everybody's got gold except Canada. And every bank's got gold and they're buying. And then the other one, of course, is Tether getting into the business. They're buying at the same scale of one of the top 30 central banks in the world, right? So you've just got this momentum that's going. None of these guys are day traders. None of them are going to sell if gold goes up or down $1,000. It's totally irrelevant. They're just amassing gold. So we're going to go test 5,000 next year, and you can buy stocks, cash flowing stocks right now. Aris Mining's by far our largest holding. The stock has a price to earnings ratio of 5, and they don't have any debt. It's a growth company. So the numbers are going to be just ridiculous. Every Canadian miner, we had 2 Canadian miners in our offices yesterday, and they're talking about, $4,000 if you're mining in Canada is absolutely lucrative. Nobody has that in their model. So we don't even need gold to do anything before every Canadian mine prints money, right? So I think it's exciting. John, I hear your comments on energy. I think the one thing that's clear to us anyway is that we're going to have a run in gas over the seasons. Lots of excitement there for the next 6 months. And there are not that many companies. NuVista just got taken out. All these other companies are going to go up 50, 60, 70% in the next 6 months. So just pick your Canadian gas name. It really doesn't matter which one it is. Some of them are going to get bought, but their numbers are gas prices going to $5 is enough to send all these stocks up tremendously. So I think the one thing about energy, I agree with you. Make a call on the price of oil. It doesn't look all that great. The charts don't look great, but the fact is, the energy space is the cheapest multiple stocks in the world. You can buy energy stocks at under 3 times EBITDA. So that's what's going to send these stocks higher. That's where the value is, right? Stock market's expensive. Oil stocks are not expensive, and oil stocks listed in Canada, international oil stocks listed in Canada, are dirt cheap. So I think there's some excitement there. So there you go. That's the portfolio for the next 6 months: gold, silver, and Canadian listed energy stocks. And that's it for me. We're writing up a note. I talked briefly about this GRO, this potash play in Brazil. It turns out there's a big seller. The seller is being taken out, and then I think this thing goes from $2 to 10. And we're very excited about that. I'm going to write it up a little bit in our monthly report, which of course I'll send out to you guys. And that's it for me.
Okay, see you later.
Thanks for listening to Lighthouse Outlook. If this conversation sparked a new perspective, share it with someone who thinks differently. Subscribe for fresh episodes every 2 weeks and visit mcnichollasset.com to learn more.